Hey traders, this is Ron Haidt. Happy Sunday. Hope you guys are having a fantastic weekend. As always, everything in this presentation is for educational purposes only. If you're using Thinkorswim, this is a daily chart of the S&P 500 ETF, the spiders. Here are the all-time highs. We are getting close, and we still have that island reversal pattern in play. This is where the gap up, and then there's a gap down, creates that double gap in there. Huge, powerful reversal patterns. If we had closed lower on Friday, like I said in Thursday night's video, this would really be bad news. We didn't close lower, but we closed way off the highs of the day, and we're still below the red line, which is the 20-day EMA. What ended up happening is more of an inside day, but when you start going up here at 318 and you close at 304, you are still way off those highs. So that bounce is actually pretty weak. Yeah, we came off the lows, but we didn't go to the highs of the day. We finished sort of midway in that candle, still bearish. On the daily chart, take a look at the Dow, all-time highs. Here's where we are now. Again, island reversal. This one looks like it's pennies below the red line. This would still be bearish on the daily chart. You know, you think about it, there was an 1,800 or $18 drop in the DIA, 1,800 points on the Dow, 18 on the DIA. We only got 4 points back. That's not very much. That's how big of a drop that was. And even though we saw a rally, it actually wasn't that good at all. Here are the Qs. The Qs are still holding on to their 20-day EMA. Until they breach that, the Qs are bullish on the daily chart. But please keep in mind, with the S&P and Dow both below their 20-day EMAs and the S&P looking the worst, this one could play catch up in a real hurry if things get bad this coming week. Now, if I pop this over to the side, we can see as of 6:45 p.m. Eastern, Dow futures down about 330, NASDAQ 85, ES, your S&P futures down 37, but it's showing a low at 29.69, so we're 17, 18 points off the lows already. But who knows what could happen till tomorrow? These could all be green in the morning by double, triple this amount. We could go limit down overnight. Who knows? We'll just wait and see. But overall, on the dailies, I would say definitely bears have a technical edge because of this island reversal pattern still in play. Now that's the dailies. What happens if we transition to a weekly? What do we see? One of the things I was looking for on Friday was that close lower because it would have turned into a bearish engulfing pattern on the weekly charts, and that would have been huge because there was going to be a pickup in volume as well, as we can see with this candle. Well, if I zoom in here, this is the SPY, S&P ETF. Each candle is 1 week. We do not have bearish engulfing, and we're still above both moving averages. So on the weekly, the bulls are still in control. That's how pivotal Friday would have been. The dailies would have cracked or had cracked on Thursday. The weeklies would have cracked. They're not there yet. So we're going to have to see how this week unfolds. So bullish on the weeklies. If we go to the diamonds on a weekly basis, how about them? They managed to stay above their 20 period. They're below their 50. They also did not complete bearish engulfing. Look at the spike in volume. It was almost it would have been too easy for us to close below that open from the week before, which would have given us bearish engulfing. Therefore, I would say S&P's bullish on the weekly. Dow somewhat mixed because we're not above the 50 period, which is an institutional line on the weeklies. But we're above the 20. So the Dow is mixed, and the Qs, you can probably guess, they're probably doing fantastic on the weeklies, and they are. This is a potential sort of tiring out candle, a reversal candle, an exhaustion candle. But remember, candlesticks on a one-off basis don't define a pattern. It's just one candle. We would need to move lower this week to confirm that exhaustion candle. As of right now, it was just some profit taking. So you have S&P bullish on the weekly, Dow mixed, Qs very bullish. So when I have the weeklies and the dailies at odds, which is what we have, so let's go back and let's just use SPY as our broad indicator for the market. Let's go 1 year daily and zoom in. I'm going to use the S&P. With the dailies cracking below the 20-day EMA, first sign of trouble, isn't the end of the world. But when you add that island reversal candlestick pattern in, it raises this to a whole new level of being more concerned. I would say very, very cautious this week. Right now, the downside target is the 50-day, that institutional line on the daily chart in orange. And if we breach that, but it's got to be on a closing basis, I don't know if this low can hold. The big target would either be here or here, so it could get ugly in a hurry. Now, what I'm going to do this week is if there's not much movement, I'm not going to do a video. If we start seeing big moves, I'll go back to doing videos every single day to keep up with what the market is doing. We could be getting close here. I think perfection has been priced into the market with people thinking things are going to go back to normal, which they're just not, but we'll talk about that some other time. So just keep an eye on the daily charts, watch that 50-day on the spiders. Right now it's at 289.90. It's going to keep rising here day by day. Maybe you want to put alert at 290, 290 just to keep an eye on it. All right. Now, how goes the market, so goes Apple, right? How's Apple doing? Or how goes Apple, so goes the market? Apple's doing great. Finished up on Friday, just under 1%, but it's not even close to its 20-day. So Apple's holding up. Markets are probably going to hang in there. But if Apple cracks, you can expect the market to get beat up too. How about the semiconductors? Look at some ETFs. They bounced off their 20-day. They actually breached it, but closed higher. If we take a look at XLF, which are the banks, they are below their 20-day EMA. So they did bounce pretty decent, right, in terms of candles. But up here is where the gap down on Thursday was. That was Wednesday night. Here's Thursday. This was a very weak rally, all things considered. So XLF is still bearish on the daily. And then if we go to the transports, again, well, actually, this one had closed up. I was going to say it was a pretty good gain, 2.85%, but the volume was pathetic, really bad volume. And we only got back a portion of the drop. They're right on their 20-day. I would say neutral here. But you know what the underlying thing we're seeing? There's nothing really wildly bullish here except the Qs. They're the only ones that are really hanging in there in something like Apple. Let's take a look at some other stocks. How about Amazon, since tech's holding up so well, not below its 20-day. The last time we were below the 20-day, frankly, would have been over here, what, March 20th? Ever since, it cannot get below it. So if I was following Amazon, or we could call this XYZ stock, the moment we close below the red line, that tells me all short-term type trades that were bullish would be over. I would consider being stopped out of all of them. If it breaks the 50-day, the target is giving back all these post-corona gains. And you're talking just under 2,000 would be the target. So this 50-day is going to be a big deal. I will say this, though. When you see these explosions out of nowhere and breaking out of ranges, they usually can go for a while. But considering how the market has already rallied so much, you're almost looking like this is going to be a false move. And this is sort of what's happening. The S&P gapped higher Thursday, and then it gets Wednesday, and then it gets beaten up on Thursday. Here was Tuesday's move, Wednesday exhaustion candle, and now we have back-to-back down days. This basically creates like a upside down U pattern, but technically there's no damage done yet. First sign of trouble, red line. The final nail in the coffin, orange line. So we do have signs of this one getting tired, but there's no confirmation yet. All right, Facebook. We still have the double top in here. We did breach the 20-day on Thursday. Friday, we got back above it. Technically, this puts the bulls right back in charge of Facebook. However, because we have a double top up here, I would still be cautious. For me, instead of being long now, I would actually rather wait for new all-time highs to be set, because then that breaks the double top and there's no more overhead supply to deal with, rather than maybe getting long something now, because I'm very cautious about the market. Just, of course, in a paper trading account. Here's Google. It closed below the 20-day on a slight pickup in volume Thursday. We're sort of a couple pennies below it here. I would say caution on Google. You go to Microsoft. I mean, look, here was the previous high, right? There was Wednesday's explosion higher. It's like, really? And then it quickly gives it back. Now, so far, it's holding the 20-day, and we really haven't closed below the 20-day until what? April 1st? This tells me during this entire time, the dips were bought. We got below it different days, but didn't close below it. We closed below the red line. I'd want to stop myself out of any short-term positions. Now, if I was a covered call trader, for instance, if I break the 20-day, then maybe I would look for calls somewhere up at the high, or maybe the other candle's high. I would probably start bringing them down closer to the money if we breach the 20-day. But if we breach the 50-day, man, there is nothing here for support until we go back down to the lows. So just heads up. All right, I had a couple requests on different types of stocks. Of course, always from an educational perspective. Here is Peloton, PTON. I don't really follow this one. There's not a tremendous amount of volume. It looks like a couple million shares or so, 8 million shares. Actually, not the end of the world. But when I look at the red line, it got below it one day here, on it here. It seems reasonable, But here's what I see with Peloton. When it does get below that nice trending moving average, that 20-day EMA, it finishes off the lows, So here's how I would approach it. If Peloton were to break the 20-day and close at the lows, that to me shows a shift in sentiment because they were buying here, If they don't buy the dip, could be over. Right now, this is a flagpole. This is the flag. There are the highs. I would want to see new all-time highs, frankly, before I would consider going long, just because the overall market, I think, is in a little bit of a precarious position right now. All right, how about Alibaba, another request? There's the high. Let's actually just do all the highs on Alibaba. Yes, that is the most recent high. All right, let's go back. So here's the all-time high on Alibaba, 230. We had the big pullback, double bottom, tweezer type bottom, although separated by about 2 days in between. And you're sitting up here. We are putting in higher lows. You are putting in ever so slightly higher highs. I would call this somewhat of an uptrending channel. I would say this, below the 20-day, it just gives you some pause. But I think the bigger deal here is the 50-day because we seem to get below the 20-day quite a bit. And the 20-day moving average in red is not always going to work for every stock, but it works, more often than it doesn't, but not here. When I go to the orange line, we did have a dip here at the beginning of May, but once we got back above it, we've stayed there. So we basically had a month and a week of staying above the orange, that institutional line in the sand. So if we get below it, that's where some caution would come in. How about Tesla? New all-time highs, $1,000 a share. Again, the red line, amazingly strong since we got above it back in April 2 months ago. So when it cracks the red line, that would tell me it's time to consider exiting positions. But keep in mind, because this is a stock on a gigantic sugar rush, when you start moving below the red line, look over here. You closed around 776. By the time the next day happened, you were at 676. You gave up $100 or 15% or so in a day. And then if you didn't get out at the end of the day, the next day it gapped down to 629. Gulp. That's how it may not look like it's far off, but by the time you try to get out, we could go from here to here or something in a heartbeat. And how about Clorox, another request? This one's been really strong. It started pushing higher in December. Then we got into the corona crisis. Spike up, pulls back, and then it just keeps on going. This stock's been around a long time. It's a staple type stock, if you will. I think for staple type stocks in a normal environment, I think the 50-day moving average is really key and important. Once we started these massive gyrations, we started to get over them. The 50-day hasn't really been touched except here most recently, and it acted as a bounce point twice. That tells me we get below the orange line, bullish trades in the short term are stopped out. Now, if this was a long-term trading position or a stock maybe I didn't want to sell, if I get below the orange line, that could be a trigger for me to consider after money long puts, maybe something at this rate with the uncertainty, maybe 90 days in time. Usually 45, 60 can be enough. Downtrends typically don't last too long. But for this one, I would just play it more cautious than anything. And last but not least, I'll just take a quick peek at gold. Not a whole lot going on. It's just biding its time from the end of March, beginning of April. It did have a breach of the 50-day, but we got back up. This one needs to break out to new near-term highs before it would be bullish. Otherwise, I'd want to take out that closing low from 6.5. And GDX on Friday, it closed a couple pennies below its 50-day moving average in orange. We have lower highs here, we have lower lows, a little bit more of a close lower, and this will go on a full-blown sell signal. So that is it. Wish you guys all the best, and I will catch you in the next video this week. Take good care.